Hello, welcome back to smarthelping.com. This is an overview video for the ATM business 10-year financial model. I will go through each tab with you and explain how all the logic is working and how this flows. In general, it's a bottom-up financial model, and all the assumptions are connected to the financial statements, income statement, balance sheet, cash flow statement, as well as the cap table and visuals, distributions, and executive summary. So first of all, we have Global Control tab. On here, you're just going to enter some general information about the company, the name, the launch year. Keep in mind the launch year will update any drop downs in the full model. For example, let's look at the CapEx. When you select the purchase date, let's say the row 1 is always a building here in this case. This drop down data here will be based on the launch year. Better case is the running costs here. So you can see these are, and I actually just updated this, so I'm updating these now. These are all going to be, whatever date selected is going to be 10 years based on this launch year. You can also determine when you want the financial model to end, so it doesn't have to be a 10-year model. It could be 5 years, 3 years, 1 year, whatever the case. You can just select the drop down here on how far you want the model to run till. And then you can also choose to include a terminal value or not, which is just for the discounted cash flow analysis. If you don't want to see the terminal value in the forecast, you can just hit no here and it will zero out. As you can see here, terminal value is zeroed out. If I do that, if I hit yes, you can see the numbers are back in there. The terminal value is just going to be based on a sales multiple, so total trailing 12-month sales times whatever percentage you put in here. And then that gives you your exit value and exit proceeds. So ATM machine, one global assumption I have here is the growth of the transaction fee. So this just is accounting for what the transaction fee, if it changes over time, if you think you're gonna raise your fees, you can raise it by this percentage per year. It'll give you a monthly rate. And then the active days per month is also going to be relevant here to determine total fee revenue. I will get more into fee revenue here in a second when we get into the revenue tab. Finally here, the model is going to solve for the minimum equity required. So this is showing you based on all the startup costs, any burn, based on all the assumptions that you've put in here. This is the minimum amount of cash investment that's needed, and this is after any debt is entered in here. So this 317 is going to flow to the cap table here, and you can see I've actually got some default numbers in here that are more than we need, so let's lower these down a little bit. There we go. Just don't want to see negative investment numbers. So and you can see the investor equity and owner equity populates based on whatever's in the cap table. Then finally, we do have some tax rates here and sanity checks. So these make sure all the different tabs are zeroed out to each other, and they always should be zero. And this is going to check balance sheet. This is going to check the ending cash balance on the monthly detail versus the balance sheet cash balance. It's also going to look at distributions and make sure the total's there equal the total cash as well as the executive summary. So we know when these are all zero, that means the correct data is showing throughout all the different tabs. Tax rates, again, you can zero these out if you don't want to see taxes, or you could put in tax rates to see after-tax cash flow of the that the business will produce. So here's the revenue. This is really the meat and potatoes of the model. You can model out up to 27 tranches of the ATM machine deployments. So for example, January 2021, I deploy 5. The average cost per machine is $3,000, so it's $15,000 cost. And we have then for revenue, the average fee charged per transaction and the average transactions per day. And again, that can change based on this percentage here is going to grow growth of transaction fee. So that could grow over time if you put a rate in there. You've also got a percentage of the revenue you're going to share, or the percentage of the fee the merchant's going to take. So if you put an ATM at your local uh, store or wherever, they might charge a fee as rent, or they might just charge you rent, and then you can just zero this out and put the rent in the running cost tab. But there's probably going to be some fee or cost there unless you actually own the vendor place. Um, so you can plan this out for up to, again, 27 tranches. So that allows for really large operations, like let's say you do 50 ATMs a month for whatever, that's your rollout plan. This will show you how much it's going to cost and how much revenue that's going to create based on all these assumptions. Note there's also a sales tax. So depending on the state or the region, it's possible that you will have to collect a sales tax. And so if this is your total fee you're charging, then you're going to have to just pay. The sales tax is going to come out of your top line revenue. If not, you can zero it out, or if you don't want to show tax effects, you can zero that out as well. And you'll see on the monthly detail, this shows you your total ATMs based on those assumptions I just showed you, the total transactions that are happening per month, and then the total revenue that's coming from each tranche of ATM machine deployment based on all those assumptions. And I also have a fee matrix here that's showing the percentage change in the transaction fee over time based on this 1% here per year, and the other numbers in the revenue assumptions tab. And then here's just the transactions per month, sales tax. So this is dynamically feeding this total revenue. Then merchant fees, and we have some other variable costs here to get down to a contribution margin, which we'll get into, well, I guess now. So the next tab is running costs. So top line is just your general, like legal fees, utility, any kind of cost to run the business that's not already accounted for elsewhere, you'd put in right here. And you can pick the month each cost starts and the monthly cost in each of the 10 years. Also, you can define a franchise fee if the ATM machines you're buying are part of a branded franchise, and you got to pay some fee of your revenue. Then you can put that in there. Again, you can zero that out if it's not applicable. Then we have these variable costs. So we've got repair and maintenance cost per machine per year. You put that in there. There's the monthly amount, and that'll just multiply by the number of machines to calculate. I believe this. Let's see, D30. Wait, where's this flows to the P&L and runs off the total machine count per month. I put that as a general. So that one I did as a general administrative. Yeah, D28. So that's going to come in right here as a repair and maintenance. And then the rest of these, so ATM processing fee is going to be a variable cost, which is 20 cents per transaction. So that'll run off the total transactions that are happening. Income tax. So this actually we don't need. I'm going to clear this out because in the updated version I have taxes flowing through a different way. And then we have useful life. This is also not required. Because we've got depreciation running in a different part of the model. So we can actually clear this all out. You can see on the income statement I have depreciation logic here. Oh, no, I don't. Hold on. I do, but I don't. So the income tax is fine. This is informing the CapEx. So this useful life of all the machines is going to flow here. Because I went in here, I'm like, oh, where's all the depreciation? Now, yeah, there's depreciation. So I do use this. Let's look at some more of these variable costs here. ATM processing fees, merchant fees. Okay. These merchant fees are based on these costs here. Which is going to take the total revenue times times this column. These merchant fees are these are variable costs. So we have let's go back over here. We have merchant fees as a variable cost, which flows down to here. We have the ATM processor fees I mentioned, the X percentage per transaction, and then there's also the franchise fee. And then the other sort of variable expense, but I put it in G&A, is the repair and maintenance cost per machine. Okay, so those are all the costs. Depreciation. Let me get into the cap table. So here, again, you can define the total shares, the percentage of the different share types, and the total investment each outside or inside investor is contributing. If you just want to zero out, you can clear everything out, and this overflow row will have the total dollar amount needed based on this amount, less anything else that's been contributed by any other entities. And then you can define the percentage of common stock, preferred class A and B here. And the real number that matters is this fully diluted ownership percentage. You can see the share value of that here, and then the total implied valuation. These just should always be zero, or else you didn't enter the numbers in a way where they add up to the total, and they always should. We've also got in distribution schedule here, investment distributions if applicable, and the internal rate of return. So cap table, CapEx. Remember, first row is building row, so if there's no building purchase, you can zero this out. Always leave column F a value in here, and note even on the revenue. For here, you're never going to leave column C blank, even if you're not using a tranche. You can zero out all the other numbers, but leave a date in here because that'll prevent this from having an error. So the other CapEx items are all based on the revenue. You've got your total tranche cost, useful life, monthly depreciation, that's going to flow over to the income statement, and the depreciation, then we've got value at sale. So this is a 5-year useful life, so it's fully depreciated by the 10th year, so it's all zero values there. Terminal value here, just put 100% if it's fully depreciated on the end month. If not, you could put in some number less than that, and then the remaining amount will be applied to any remaining fixed assets that are not fully depreciated. We've also got startup costs, so these would be any costs related to the business before you actually get operational. So it could be like, I don't know, website, consulting, probably on this is legal and consulting fees is going to be a big one for this type of business. You've also got debt schedule, and if you do include the terminal value, then the debt is going to be assumed to be repaid on that month if it's still being amortized by the time, and if not, it'll just flow through until the full term is finished, and that will flow over to the statements accordingly. As you can see here, if I were to put no, this will then not stop in month 120. It just keeps going. And then that will flow over the balance sheet. It'll show you the balance of debt over time. Let me undo that. Okay, so debt schedule. Income statement, here we just have ATM fees as our only revenue source. Over time, we went over these variable costs. We have total variable costs, contribution margin. We have some G&A, startup costs, sales tax, total operating expenses, EBITDA, interest, depreciation, tax items for the exit. If there's an exit value here, we're applying it all to the business. This should actually be frozen. And then you've got net income after tax here. Okay, and then the annual income statement is the same thing, but on an annual basis. Balance sheet. So for here, we just have current assets of cash. We have the fixed assets of all the ATM machines, accumulated depreciation, total assets, which is just totaling the total cash against the total value of the ATM machines, and then less any accumulated depreciation. Liabilities, just the one debt proceeds, if you do have it in there, it'll show here. And then any equity contributed will show here in equity. You've got retained earnings, and then finally total owner's equity total liabilities plus owner's equity, and then those always will equal the total assets, or else there's something wrong. So these are all the formulas all work here really good on a monthly and annual basis. We've also got cash flow. So cash flow, you've got the cash flow statement is going to show you what's happening on a periodic basis, monthly periods of the operations. So operations are just revenues, expenses, interest, tax. In this case, you've got investing activity. So in there, we're saying it's the investment of the ATM machines, and then the sales proceeds of the business. Then for financing, I'm defining that as any long-term debt, principal repayments, and sale of company stock. So it's just a way to organize it. And then those all roll down to just a net change in cash in each month. And that will roll over to the balance sheet here. And so you know you've done things right when you're balanced here, because that means whatever's on the income statement that's flowing over to the cash flow is matching what's on the balance sheet. So we're all looking good there. And trust me, there's a lot of sanity checks that went into making sure that was correct. Okay, visuals, just some high levels, 10-year financial analysis, expense summary, total ATMs over time, total transactions per month over time, average number of transactions per ATM per month, average EBITDA per transaction. This is an interesting one. And then average fee per transaction, monthly cash flow. Actually, I changed these. This is just monthly cash flow, and then this is monthly accumulated cash. So this is an aggregate of this, and then you got gross profit per year, gross profit margin. Distributions, this is your discounted cash flow analysis. So we've got all the periodic cash, positive monthly cash flows, negative monthly cash flows. The equity that was used is going to be used to pay off that. Any remainder is going to be distributed here. And you can see the project IRR 63%. If you apply a discount rate, you get a net present value here of 1.8. Then we also did the same analysis for the investors and owners pools. And you can see these IRRs 36.4 and 117.1 will match the cap table totals here, 36.4, 117.1. See those match, so that's good. And you can see you can apply a discount rate individually to the investors and owner pools and get a net present value there. I've also got executive summary. So here's a high level look at all the financials. You've got all the revenue, all down to EBITDA. You've got all the other cash flow items. You can see everything kind of in one snapshot of all the items that are going to affect cash flow. Also some IRR and return multiples below here. Break even, like I said, it's going to take total variable cost, total fixed cost, and give you an annual break even revenue number and a chart for that. The monthly detail is going to be where you can actually see all the assumptions playing out in a detailed way. We kind of went over this already. Just gets down to cash flow and some of the advanced KPIs. Annual detail is the same as the monthly, but it's on an annual basis. And so that's the model. So if you want to try to plan out, opening or running your ATM machine business, this is a great tool to figure out what cash is going to be required, what assumptions go into how much revenue you think you can make. And, it's a very, very good financial simulation here. Again, the link will be in the description box below. I'll also post this to a couple of the vendors I sell templates on, and it's only going to be $45 one-time fee. Alrighty, this is all I got for you. See you on the next one. Don't forget to like the video, subscribe as well.